Welcome back, everybody, to another Tips for Mortgage video series. My name is Mike Parkinson. I'm a mortgage broker with Dominion Lending Centers in Campbell, British Columbia, joined by my cousin Jaden Bax in Crossfield, Alberta with Avenue Financial. How you doing, Jay?
I'm loving life. Beautiful weather out here. We went to the zoo yesterday. Couldn't be better. How about you?
What? You went to the zoo
Yeah.
in the snow?
Yeah, there was no snow. It was I think, a 10, 12 degree day, something like that. Yeah, my boy was out in his t-shirt, no coat. We were loving life.
Oh my God, that's awesome, man. But
Yeah,
tomorrow it'll be minus 40, right?
that's right. Exactly. Yeah, we know there's at least one more of those coming before the end of the year, but it's all good.
Perfect.
Weather can be whatever it wants to be. It just is what it is. But rates
Oh,
are moving in really the ways
getting
that we want them to
exciting.
be.
Getting
Yeah.
exciting, Jay. It's there's a lot going on. Like this is starting to unravel here. It's getting real interesting. So yeah, we wanted to talk about that today. We're going to try to hit everybody up every week or two about rates. Obviously, as a lot of you have probably heard and know that Bank of Canada did not do anything a couple weeks ago. But in the U.S., the U.S. Fed raised rates quarter point here yesterday, which pretty much we were all, they pretty much had to because that's what the market priced in. Jay, you made a really good point about why you think they did it. So you want to talk about that?
Yeah, absolutely. I think they were backed up against a wall, and basically, like you say, the market had priced it in. They Powell has been so aggressive in his rhetoric about, we got to kill inflation. We really got to rise these rates, and we're going to do whatever it takes to get back to our 2% base rate of inflation. We really got to do all of this. And then Silicon Valley Bank and the Bank in New York, Credit Suisse is happening over in Europe, so things are starting to float between economies,
Right.
and so for them to all of a sudden have 2 weeks ago be speaking so aggressively like that, and then pull on the brakes. In my opinion, if they would have just gone with a zero, that would have really shaken confidence in the
Yeah.
market. And like you said, Mike, it would have been people asking like, well, what does the Fed know that I don't know, and I got to get my money out of that bank before it collapses as well, right? So, really, that at the point they're at now, that quarter point hike doesn't make any kind of
It
tangible
doesn't.
difference.
No.
It's already, they know that it's not going to have an impact on the economy. They know that, as we talk about on a weekly basis, these interest rate hikes are lagging have lagging indicators,
Huge
right? And
lag.
so
Huge lag.
so
Yeah.
by the time this one hits the economy, it's already too late because our interest rates are way down again, right? So we really think it was a nothing thing. And it's just another sign of the cracks that are in the North American economy right now. Really, really interesting. When you talk about some of the other things going on that could really push us into a recession and really hit rates down pretty aggressively, probably within the next little while here.
Oh man, yeah, and it's I think it's more than just the North American economy. It's actually worldwide, right? There's a lot of things going on that are hidden that they don't talk about a lot. But then there's Silicon Valley Bank, which you said everybody's tied to. Other banks, in the U.S. are starting to show some serious issues, right? So the higher they keep rates, the harder it's going to hit, the banks long term, right? And it's funny because Powell, the Fed chairman there, said he wants to predicting they're trying to keep rates for held higher for longer until like into the end of 2024, but I could really not see that happening. Like I don't know how that's going to work. They're still doing QT behind the scenes, quantitative tightening, taking money out of the economy behind the scenes that they don't talk about. That's another form of actually raising interest rates on itself, right? So another thing they don't talk about, Jay, is corporate credit, which is
Yeah.
ginormous. And they're also talking about a lot of these banks that are tied into commercial real estate, and they're taking a pounding, right? So, and a lot of these are coming up for renewal here at much, much higher interest rates. The corporate credit, just the junk bond corporate credit, I think there's over $1 trillion coming up for renewal this year alone. And they're used to interest rates of low rates like 3% or so. Junk bond is just like C-type credit, lower type credit. So they're coming up for renewal. They're probably going to be in the 8% plus. So they weren't making any money at 3%. So what's going to happen there? And then we talk about the spinoffs on that, the derivatives, which means, all the people that invested in that to try to get a higher yield and whatever. If those guys start to falter or go under, it's just going to be a freaking disaster. And then the corporate credit alone, coming up for renewal, refinancing, how's that going to work? Money's getting very tight with banks. Their lending policies getting much tighter, so they're not lending as much funds. They're not having as much money come into the bank. So it's really getting interesting. So if you unravel or unpeel the onion, I guess, it just doesn't look good. So I don't know how they're forecasting their forecast moving forward. But basically, I think that they're just using talk to try to tame demand personally, and scare tactics. And they're just, I don't even think they know what they're doing anymore. I think they're just reacting. So I don't know.
Yeah, and honestly, but that's been the case. It seems like that a case of the tail wagging the dog. The market has been leading everything, for the past 9-10 months, and the Fed in the States and the Bank of Canada are just reacting. That's not what we need from monetary
need
policy,
leaders, right? Not reactors.
Exactly. And so, what does the market say now? The market says that bond yields are going down, bond pricing is going down. What does that mean? It means that we're starting to get some really interesting offers for the fixed rate market. But they're a little bit they're interesting, but they're a little bit scary. And I've said this on other videos that I've done, but there's a great a great rate really being pushed right now, the 4.64 with one of our lending partners on a 4-year fix.
Right.
Really kind of ahead of the market. There's one 5-year right now that I know
That's
of
for
at
a purchase,
4.59.
right? For a purchase.
Yeah, for a purchase, yeah. And that's insured, so less than 20% down. Looks like a great rate when you're talking about the 5.25 that we had 6 weeks ago, 8 weeks ago. But I think that 4.64 is probably about 3.5 years too long of term, because where we're going, where the way that we see this market developing, I think we're going to see a relatively aggressive lowering of rates over the next 6 months.
Yeah.
Right up to
I
the end
agree,
of the
Jay.
year. Don't you agree? And so it's really interesting to see. There's one thing that banks are fantastic at, and mortgage lenders, they're fantastic at making money, and they know that the best way to make money in this current economy, the best way to lock in some value for themselves for the next 4 to 5 years, is to lock people into a 4 to 5 year fix.
Right.
Just far and away, they're the best deal for themselves. And I don't think it's going to be, I can't really even recommend a 3-year fix for anybody anymore. I know we've been going on and on about the 1 and 2, but especially today, it's 1 and 2 years are a variable. Those are your safe spaces, right?
Yeah, and it's our opinion as well. Like, again, we don't have a crystal ball, but if you throw the writing's kind of on the wall if you look at things, and it's really tough for people right now because the 1 and the 2 year fixed are obviously higher than the 3 and the 4 and the 5, right? So it's just about strategy, I think, if you explain it to them properly. And then if you can get a decent discount variable, I think that's a great thing to look at if you can afford that as well, because especially if rates start to fall, that just means that you're paying less interest every time it falls, right? So it's something to think about. We don't know where rates are going to be, but I think the market's pricing in at least a 0.5% to 1% cut by the end of the year. Am I correct on that, Jay?
Yeah, I've seen 1% on the variable side being priced into the Canadian market.
Correct.
And that's where I see things going as well. And so all of a sudden that 5.8%, prime minus 0.9, 5.8% variable doesn't look so bad against the 4.64, because that it's continuing to go down in that direction, right?
It'll take time to get down there, and it is higher now than obviously what you're discussing there in the longer fixed rates. And I looked at the 5-year bond yield. Canadian bond yield was down to 2.775, I believe, which is
that's the lowest it's been in 7 months.
Yeah, and if you think about it, just 2 weeks ago, Jay, it was 3.6.
Yeah,
something, wasn't it? Yeah. Anyway, if memory serves me right, but it's unbelievable how fast it's come down in the last couple of weeks. So and I see other bond yields are coming down. So it'll be really interesting. Actually, in the US, the 2-year I'm not sure if it's down more today, but yesterday it dropped quite a bit. So what that means is if the 2-year gets lower than the 10-year, it's called an uninversion, which means that we're really into a recession. So I think we're pretty much almost there. They are predicting a recession, and many are predicting a deeper recession.
Yeah.
While some are still, hey, maybe we're going to have a soft landing. I don't know. What are your thoughts on that?
No, I think we're looking at if you look at the way that the cracks formed in 2008, we're likely at a similar situation as there. Some people are saying it could be worse. The thing from a purely mortgage perspective, obviously we don't want to see a deep recession. We don't want to see people losing their jobs and everything that goes along with that. From a purely mortgage perspective, there's a great chance that over the next 18 months that there's going to be a quite aggressive correction in where rates are, and it's just going to be interesting to see because it seems like either the Bank of Canada, the Fed, overreacts to the market on either side. So there might
Wait,
really be some fantastic discounts from prime and really, really low variable rates, incredibly low fixed rates in our future as well. Just have to keep our eyes open for there and see what develops with this market.
yeah, we're obviously, in my opinion, we're not going to see any more hikes in Canada. I don't think.
No,
I
no,
think they're done, and I think they're done in the U.S. Personally, I'd be shocked if they went up some more. But again, the numbers that they have coming in are higher than expected, and are they accurate? I doubt it. But that's the numbers that they have. Their inflation's higher than we are, but we are more sensitive to rate hikes than they are.
yeah.
In Canada here. So, and Bank of Canada knows that, right? So it's just something to consider. When you're thinking about what you're going to do or the product you're going to get in, just have a good conversation with your broker. And if you guys want a
Yeah.
second opinion or you want to chat anytime, we're happy. Hey, we're no pressure sales. We're just trying to give you the right information so you can make the right decision. So call myself in BC or call Jay in Alberta anytime. We're happy to chat with you. Have
Yeah. Thanks so much, guys, and we'll see you next week.
a great day.